Hello everyone. As you can clearly see from the screen that I am sharing, the subject of today's video is quite clearly visible to all of you. So I am going to briefly discuss an investment strategy for salaried individuals. How this idea came to my mind was that I was having a conversation with one of my peers the other day about the importance of investing and all of that. And the person on the other end told me that the idea of investing is very skeptical as to blocking a certain amount of money for such long, and and life is uncertain, probably that we never know that ending up investing so much, and life is uncertain, you die at some point, and the whole investing idea is just not worth it. So at that point of time, I mean, I wanted to be upset with that thought process, but I also, I gave a smile or a smirk, as whatever you want to call it, because that idea and thought process was not quite appealing to me. And I think it's not the fault of the person who was speaking on that end. It is actually a very common thought process that we see nowadays amongst all the people. They tend to neglect the idea of investing. They do not realize the essence of investing, and especially salaried individuals who want the idea of getting a salary and spending it to be exciting. So investing can never be exciting unless and until you actually realize the essence of it. You want to buy a lot of things on EMIs. Let's say, for example, I mean, you get your salary and you know that you will get a fixed amount every month, and you will be in a position to pay EMI, buy anything and pay EMIs, throughout your life, just to impress people who do not actually care about those things. So I do not think that is a very good idea. So I just wanted people to be aware of how you should be smart as a salaried individuals, and not just get into the trap of EMIs and spending your money, overspend your money into things which are not required and which are not going to give you good returns, and it is not going to actually help you, help in the capital appreciation process. Let's say, for example, you are actually spending 100 rupees when you can actually earn 50 rupees on that. So actually you are at a loss of 150 rupees because you're spending 100, so you don't have that 100 anymore, and the 50 that you could have, the opportunity cost of earning rupees 50, is not there anymore. So you're losing out on the 150. In fact, 250, I would say. 100 rupees the principal amount, 50 you would earn on it, 150, and 100 that you already spent. So 250 is the total opportunity cost of not putting your money into a good basket and spending it on worthless items. So this is the objective behind recording this video. Now, how to go about it? I'll try to keep it as brief as possible, and so that it is in the best interest of the people who's watching it. So let's say, for example, you own, let me just take a base amount of, let's say, 1,000 rupees. You earn 1,000 rupees a month. Obviously your salary would be higher than that. Just assume the base of 1,000 for now. So 1,000 rupees you're earning. So for investment amount, you should allocate, I mean, you should keep aside 30% of the amount that you're earning. I mean, I'm not going to the fact that there's a CTC is different, the cost of the company is different, and the in hand that you get is different. I think probably you should consider in hand as a matter of fact, because ultimately that is the amount of money that you're getting. Also, one more idea which is quite astonishing to me is that people think, salaried people think, that they will be getting PF at the end of the retirement and that will suffice. I mean, for example, let's say when you get the chunk of PF, you have to put it somewhere, right? I mean, and that point of time, instead, I mean, you would obviously be a senior citizen, let's say, for example, and you would be, very risk averse, and you would want to put into FDs and all that. That doesn't make sense when you can actually invest the amount from now. You will get the PF amount as it is, but also you can also start investing at this point of time and earn a good return. I'll come to the plan how you can go about it, but just the idea of waiting for PF at the end of retirement so that your life can be secured is not a very good idea. It's a foolish idea. So yeah. So basically, what you need to do is, coming back to what I was saying, 1,000 rupees you have, 30% amount you need to keep for investment purpose. So that comes to 300 rupees. Now, for that 300 rupees, how to go about it? Now, you might be getting a question, what about the remaining 70%? So this 70% amount, I have recorded separate videos on how to, allocate this 70% amount that you're not investing into other areas of life. So you can just scroll through my channel, and if it's not feasible, I mean, if you're not being able to find, you can just always ping me and I'll share the link with you. So this video is specifically related to the investment purpose. So the 30% amount that I've actually made a specific pie chart. I'll just walk you through that pie chart in a moment's time. So the 30% amount has to go through a lot of investment channels, and you need to allocate it in such a manner that you are actually well diversifying your investment, the portion that you're actually you have. So I mean, there's a saying, right, that you don't put your eggs in one basket. So this is the whole idea. So let me just walk you through the pie chart that I've prepared for your understanding purpose. So you can already see this pie chart, and you will see it is divided into 5 parts basically. The highest allocation is to protection based assets. The next highest you will find in under risk free growth based assets. I'll come to what these actually are if you don't understand it already. Next, you would find 20% into growth with risk based assets. The remaining 15% is into high growth assets, and the last 10% into speculation activities. I'll briefly discuss these asset classes so that you can actually understand it in a better manner. So coming to the 30% allocation, this is the highest chunk. It should go into protection based assets. And what do I exactly mean by protection based assets? So protection based assets are nothing but the term insurance, life insurance plans that it is very quintessential to have when you're actually getting your first salary. I mean, you should always start, if you're not earning that much at an internship level, when you actually get a good job, you should start with a term insurance plan. And when you're young, the premiums are very low because it is less probable that you will die at some point. Sorry for the very bad language, that you will die, but that's a fact. So I mean, when you're young, the premiums are low and the premiums are fixed for throughout your life. So if you're 40, you will be paying the same premium that you're paying. I think it is roughly around 6,000 per annum. If you take a coverage of 1 CR, if you're around 23, 24, I think that is the average trend going on in the industry. So when you get you get to pay a fixed premium even when you're 40, even when you're 50. I mean, whatever the coverage period is, and the premium amount is not variable. So that's the best part for a term insurance plan, and because it helps you secure your life. For example, in case of some unforeseen circumstances, if during your demise or something, your family is at least secured, your dependents are secured. Don't go into the fact that my parents are not dependent on me, or we have a lot of property, so I don't require to but insurance premiums are expensive and I do not want to invest it. It is the need of the hour, and you should have an insurance plan. Secondly, term insurance and life insurance plans are there. Next comes Mediclaim, as you already have a health insurance, you can call it as we call it in the general parlance. So health insurance is quite important. You see, I mean, life is uncertain and unforeseen circumstances can occur, be it an accident plan, be it anything whatsoever. I think accident plan comes into purview of the life insurance policies only. I think there are a lot of plans, disability plan and all that. I mean, that you have to just go through and decide what is best for you. And so Mediclaim is also important. You can have a whole family coverage, you can have an individual coverage, but family coverage is important because I mean that saves a huge amount when you actually something happens and you're not in a position to give such a chunk of money to a hospital, or let's say for example for your treatment. It is a blessing in disguise. So I think protection based assets are of paramount importance and they should be prioritized. And the whole idea of protection based assets is not such that you do a cost benefit analysis कि इतना पैसा लगाया तो इतना मिलेगा कि नहीं. It's not that. The idea of protection based assets is not undertaking cost benefit analysis. It is just to secure your life, and that is why the name protection based assets, because they help you secure the other assets that you're investing into. Next, coming into the 25% allocation, which is into risk-free growth-based assets. You will find the major old people, who are risk averse. By risk averse, I mean who are scared to, invest into risky assets. Those people actually invest into risk-free growth-based assets. So what are these assets? FDs, PPF, and post office link plans and a lot of things. So these are basically, you will not be able to beat the inflation, agreed, but definitely you need to have some, I mean, some portion should go into these assets also, because there are movements within the markets. If you see equity markets, if you see the bond markets, there is quite volatility into all of this. So I think you should have a chunk allocated to these risk-free assets, which is certain that you will get return from, because you will get interest on FD, you will get interest on PPF, and post office will also give you a recurring source of income. But obviously, you will not be able to beat the inflation. That is a given fact. But a little proportion should go into these assets as well. Next, coming to the 20%, which is growth with risk-based assets. So basically, this is nothing but the equity, the stocks that you're going to invest into. You have equity mutual funds. You start a SIP of, let's say, for example, a very small amount. If you're starting to invest, if you have a very low salary, you can start with the SIP, and you can buy gold coins. Let's say, for example, if not gold coins, you can invest in sovereign gold bonds. There are a lot of options. There are debentures, there are bonds. Nobody actually invests into debenture and bond markets because the fixed income market of India is not yet that developed as it is in countries like US. But slowly and steadily, we will move towards that progressive stage as well. So equities you can invest into mutual funds. So these are somewhere with risk you get higher the risk, higher the return. So with risk element involved, the probability of returns are higher, and you have obviously experts dealing with your money, but that doesn't, as a matter of fact, assure you that the money will grow. there will be, cyclical fluctuations, but as a whole, it is a good way of investing your money and with expecting higher returns. So this is, so I think we have discussed the 75% allocation, 30, 25, and 20. Regarding the 25%, the 15% should go into high growth assets. Now, high growth assets could actually be more risky equities. Let's say, for example, which is more risky and it is going to give you high growth. It can also be investing into real estate in the form of REITs, for example. Let's say buying the units of real estate investment trust. So I mean, and also it can be high risky equity funds, that because when you actually screen out equity mutual funds or debt mutual funds, when you would have observed that you see a riskometer, that how risky is this fund. So obviously with higher risk you get higher returns, so you can get into those modes as well, and the proportion is less because these are risky and you would not obviously want to be in a position to go away, get rid of all of your money. So I mean, but you can obviously take the chances. So 15% should go into these high growth asset classes. Now speculations. Speculations are the highest, I mean the riskiest asset classes. I mean without proper knowledge, it is not recommended, but still I've included in this list. If you are slightly risk averse, you should not go for it, because there is high probability that with less knowledge you will not be able to generate good returns and you will end up losing your money. So what you can do in that case is the 10% you can allocate in the other four asset classes as per your own convenience. You can start you can increase your SIP amount, you can increase your share investment amounts and all of that. So speculations, a lot of people who want to try are derivatives. Derivatives are call and put option. To talk about them briefly, I cannot discuss the call and put concept in detail in this video, but it is just like betting. Let's say, for example, you're betting on you have an IPL team, or you have a favorite team. Let's say, for example, Kolkata Knight Riders, and there is a score decided 160, that the team will make a score of 160. There will be a set of people who will be betting that the score will be above 160. There will be, 160 is as per all the bets that are placed, the weighted average bet is 160. So the derivatives work in such a manner that people betting above 160, people betting below 160. Some people say the score will be less than 160. Some people say that the score will be above 160. So if the score is above 160, you will get an amount, and if the score is below 160, the people who had had placed their bets on the score being less than 160, they will get an amount. But obviously to enter into these bets, you will have to invest some amount, which is called the premium amount. Option premium, we call it, call option, put option. But there are also other derivative classes like futures and swaps and interest rate options. Just give you an idea that derivatives is nothing but a concept of bet only. If you look at it at a very narrow perspective, we can have a separate video on derivatives if it is an area of interest. So I mean, the 10% can go into speculations, because speculations are nothing but a bet. You're actually trying to you are not actually sure of the circumstances. For example, equities you can value, bonds you can value, and you can accordingly make a decision based on them being undervalued or overvalued. But that is not the case for these highly volatile asset classes like derivatives, where you're actually placing your bets. You're betting on something being higher or something being lower than a benchmark decided price, or whatever you want to call it. So these are risky classes, and you need to take your decisions accordingly. So this is how you should, as a salaried person, be disciplined about allocating your 30% amount into these 5 areas or 4 areas if you do not want to get into speculation activities. Speculation can also include intraday activities. Let's say, for example, you are buying a share, and you believe that the stock price will rise in a certain day. So you buy it when the stock price, the markets open, and then you sell it when the prices are increasing. So that is completely based on your speculation that the stock price will rise. Nobody has actually told you that the stock price is going to rise. That is because you are reading a newspaper article and you will feel that because of this decision the stock price is going to rise, or you're researching on something, you're reading an article and based. So basically that is just an application of knowledge, just speculation. It is not sure that that thing will occur or not. So this is speculation. So basically, this is how you allocate as a disciplined investor when you are a salaried person. Don't depend on provident funds and all of that. Obviously, you will get an appreciated amount in the form of provident fund, because that also generates a return. But please do not be, stay dependent on that. You need to have a good chunk accumulated, even apart from provident fund, as a salaried individual. And of course, I'm not saying that 100% salary should go into all these five. Though personally speaking, I allocate more than 30% only in all these five modes of these avenues of investments. But 30% is the minimum amount that you need to have to lead a disciplined life. and disciplined investment life, and have a good portfolio accumulated over the period that you will be serving as an employee. And I think it's a good idea to not rely just on the provident fund. So I think that's all from my side, and I think I really hope that this video would be helpful for all of you who are watching. Thank you so much for staying till the end.